Hi, I am Apurva Sheth, and I welcome you to this very special conversation with the management of Five Star Business Finance Limited. So, Five Star Business Finance is coming up with its IPO on the 9th of November. So, today we are going to have a conversation with the management. So, from the management team, we are joined by Mr. Lakshmipati Deendayalan. He's the chairman and MD of the company. And from my team, I have Veer Trivedi, who tracks the banking and NBFC sector. So, congratulations to you, sir, for coming up with an IPO. And we hope and wish you all the best that your IPO goes out with successful colors, flying colors. So, congrats to you.
Thank you. Thank you for the good wishes and thank you for having me on your show.
Yeah, thank you. We are happy to have you here, and we would like to know about the company. So my first question is that the company essentially deals in giving out secured loans to small businesses and shopkeepers in the services segment with a ticket size of 3 to 5 lakhs in tier 2 and tier 6 cities, from tier 2 to tier 6 cities. So what makes this segment so special, and how big is the market actually in this particular segment?
Yeah, to start with, very good question. Let me take you through 20 years back because today everyone speaks about lending to small businesses. But when I started to look into this segment in 2002, when I joined Five Star, it's close to 20 years now. No one was willing to lend to this segment. People called them untouchables, vulnerables, very difficult to assess their cash flows. Predictability is very difficult in this segment. So none of the bigger guys like formal lenders, like banks and NBFCs, 20 years back, they were not looking into this sector very positively. I decided to look into the sector because we wanted to move away from vehicle finance, which every NBFC wanted to go deeper into it. So we were the first NBFC. We broke that hire purchase lending to vehicles or consumer durables and moved towards lending to so-called nano or small business individuals 20 years back. But it was a long journey for us. But we have learned a lot from them because it is not an easy game. It's not like lending to a microfinance or a group, lending to a vehicles or lending to a gold, where your underwriting is so light. Whereas if you want to lend to these customers, the customers like kirana guys, flower vendors, milk vendors, self-employed like plumbers, carpenters, barbers, you know that India is a land of millions and millions of shops. And India is a land of millions and millions of self-employed. So you have a huge market here, but you have to underwrite them very well. To underwrite them, you have to be with them for a long period to understand their ups and downs, what kind of cycles that their businesses can take place, and where is the difficulties that comes from them during the difficult times. How is that you can protect your EMIs? Not slipping towards non-performing assets. So that's the art that what Five Star has built for last 20 years very successfully, both in profitability as well as in quality. When you ask about the market size, we have given an DRHP CRISIL report, which has done a survey on behalf of Five Star, taking these service customers, whom I said single shop owners, self-employed, who can afford to give a property and take a loan. That segment, what currently Five Star is dealing with, that segment is close to 20 lakh crore business opportunity. It is 22 trillion market opportunity in our country. That's big. So any guys who wanted to deal with them can come and deal. But my only prayer is you have to learn them first, then put your growth pedal into action.
Sure, absolutely. So that's a wonderful journey that you have, gone through and shared some of it over here. So absolutely fantastic it is. Now we have also come to know that you prefer giving loans to services over manufacturing. So why is that the case?
Very simple. 20 years back, when I decided to get into this segment, I was very clear we should back a business guy who deals with a common man. If you see our customers, they are predominantly into service, and within service also, they are predominantly into essential services. That means without them, a common man cannot lead a common life. So you cannot be without eating vegetables, taking milk, taking rice or proteins. So you cannot be without a haircut. Nothing moves around without electrician, barbenders, or carpenters. So these are the essential services which a common man cannot ignore. So we thought this set of customers' cash flow are intact rather than getting into a cluster, a manufacturing cluster, where in the line of order, our customer comes last. So anything happens to economy, the last few guys will be severely affected in the manufacturing sector, which we have seen in Demon, COVID-1 and COVID-2. So service sector is last to get hit, first to bounce back. That's our logic, and that has worked well in Demon, that has worked well in COVID-1 and COVID-2. So that is why we are sticking on with lending to services, that to essential services for a common man.
Okay.
One question from my side. Lending is one of those rare business where selling the financial product is not the most difficult part, unlike other businesses, because there is no shortage of people who require money. But getting your money back is where the problem is. And to ensure this happens smoothly, your company follows this 4C system. So if you can briefly explain to us what this 4C system stands for and what it does.
Yeah, so let me brief it. Our underwriting goes with 3C system, which is character, assessing the character of the family, assessing the cash flow of the family, and last, assessing the collateral which they are willing to give for this loan. So this is a 3C system where we our basic belief underwriting comes from. See, for us, the character plays an important role. Many people, they don't agree with this statement, but very clearly for us, which is working very well is, we when we go for a verification of a file, first of all, we will go as if it's an unsecured loan. Collateral will not be in our thought. During the assessment of a family, character comes first, cash flow comes the second. If you're able to assess the character well, our thought process and our experience is, whatever the cash flow goes up or comes down, your ability to go and collect the EMI is high, because the intent is very important than the ability. So we give more importance to character of a family, whether we will see whether the family is a fighting family or a calm family, the family members are, any one of the family members are drunken, a gambler. So these kind of small things that we get from our inspection when we do surprise visit to the customer's family, that's the first tick mark that has to move here. Once that tick mark has moved, then we'll go to the cash flow. Going and visiting the business unit and visiting the living condition of the family members, that is the very critical part. I can't speak too short about it, but too short is from the living condition and asset creation, what our customers have been done. With that, we take the flavor of what can be his monthly income, and what will be his monthly profits, and what can be his comfortable level of paying EMI. That's we call DBR, debt burden ratio, that we derive. Finally, it comes to the collateral. So collateral is the final part where customer has to move forward. We lend to houses with RCC slabs. We don't lend to hut houses. We don't lend to thatch houses. Our houses are pretty much same. Like any housing finance company, you come across with 5 to 10 lakhs ticket size. So it's very pakka houses. So this is how the 3 C's work, starting from character and ending with collateral. Once the customer clears in all the 3 C's, then the sanction has been given. Then he has to create a mortgage in the sub-register office. Then the money gets into his bank account.
In this IPO, 4 major shareholders are selling their share. So regarding this, point number 1, why are they selling their share? What is the rationale behind it? And will they be selling more in the near future?
The rationale for them selling the shareholders is very simple. Because 5 Star, we don't need any capital. our capital adequacy is around 70%. As per regulatory, our capital adequacy can be somewhere between 15%. You are at 17%. That's the headroom that we are available for us to grow. And when grow means your capital adequacy has to come down from 70 to wherever we want to bring it. So no need of money for the company as of now. Very well capitalized, and we are generating a PAT of 450 crores last year, and this year also we'll be generating a good PAT. So the internal accrual is also very strong. So we don't require any primary. Second, as a promoter, I'm not selling anything. I have close to 18-19% stake in this company, and I'm not selling it. And neither my family members are selling any shares, and I don't have any mortgage or lien on my shares, and I don't have any loan as. So you don't, company is not in the need of money, and promoter is not selling. Then if you want to bring the company to IPO, someone has to sell, right? So that is how we requested our 4 long-standing shareholders taking company into public. They are requested, and they are selling some portion of their ownership. No one is fully exiting. Matrix Partners, who are the long-standing private equity guy in 5-star, who came first in 2014-15, he's also selling 50% of his ownership. So no one is selling in way. 4 shareholders, as you rightly said, Matrix Partners, Norwest, Sequoia, and TPG, they are selling some portion of their shares to ensure that we are above 10%, which is the regulatory compliance as per SEBI. When you want to bring a company to IPO, at least you have to bring with the 10% of their shares coming to the IPO. So with our request, they have accepted my request, and they have offered this offer for sale has been accepted. That's how we come to the IPO. As I said, now their intent of selling shareholders is not there. So I don't see going forward also near future. I'm talking about near future, because long term they have to exit and they have to give back their money to the LPs. That's the fundamental, right? For the short term, I don't think anyone is going to be sell, because they see the uniqueness in this company, the value creation in this company. We are creating a ROA of around 8%. No other NBFC has such a high profitability, lending to so vulnerable sector, and our quality of asset is around 1% is our NPA. So you don't find this kind of rare ROA versus credit cost at this numbers. So they are very happy to see the compounding happening in 5-star. So I don't think they'll be bringing any of the shares into the market.
So my next question was about ROA itself. So, just like you said that you don't need any debt in the near future, but whenever going forward, like from a medium to long term perspective, you would require some debt to grow. So at that point of time, what is it that you expect in terms of sustainability of these ROAs?
No, I said capital. I didn't mean debt. Debt is a part and parcel of any lending institution. So we need more debt as we go forward. I was referring about capital alone, capital money alone. I can't give any futuristic statement since we are in IPO mode now. But what I can clearly say in near short-term future, we will not come for any primary raise, because we don't want to dilute the existing and the new shareholders going forward, because you have such a good headroom. Just to give some data, our debt to equity is 1:1. As per NBFC norms, you can go up to 7 times. We are just gone 1 time. So you just imagine what kind of legroom that we have, 5-star as we go forward. That will generate a lot of ROE. Today, even at 1:1, our return on equity is 15% annualized as per the June numbers. Imagine when we go to 3 times or 4 times, if you just multiply that with ROA, you will get what is the ROE that will be coming out. So we are very confident, and we are very optimistic that 5-star will focus more on return on equity or return to the shareholders as we increase our leverage or debt to equity more and more.
So the funding cost is around 10.5%, and the spread that you are earning is around 13 to 14%. So how do you see them changing as the repo rates rise?
So again, even in the liability front, Five Star is in a very sweet spot. Why I'm saying is by 2020, in 2020, our cost of fund at the balance sheet level was around 12.5%. That has come down to 10.5% as we speak. That is the cost of fund from a balance sheet perspective. But the incremental cost of borrowing, which was around 11.5% in 2020, that has come down to 8.5% in June quarter. Even in June quarter, we raised close to 500 to 600 crores from marquee public sector names, where our cost of funds were around 8.4%. Having said that, our NIMs will be in the range of around 15%. That's what we envisage. But as you speak, in June quarter, our NIMs will be around 17-18% because we didn't pass on the benefit what we got from the borrower to our customers. Because we were waiting for the interest rate cycle to peak in. Once we see the interest rate cycle has peaked up, definitely we will be passing on close to 150 to 200 bips to our customer. That will bring down our yields from 24 to 23 or 22.5%. But I don't see any compression on NIMs because our borrowing costs also going down. After the IPO, once we reach a size, we'll be taken to AA category also. So once you go to AA category, you have marquee names like development financial institutions like NABARD who can come in, and insurance people can come in, and we can get a good quantum at the cheaper price. Again, that will be benefiting our NIMs. So I don't see any compression in yields, compression in NIMs, compression in spreads or NIMs going forward.
Generating a NIM of around 15-16% on a secured book, seems too good. So do you foresee this segment getting heated up with banks and other big NBFCs?
So my conscious thought is neither the banks and NBFCs cracking this business model will be very difficult. Because as I said, like gold finance or a vehicle finance or a microfinance, this is not a templated model. You have to really work harder and get the underwriting right. To get the underwriting right, at least you have to spend 3 to 5 years with them, understanding their cash flows, understanding the behaviors, both in good times and bad times. And you should have a stronger security like what we have, and your collection system should be very strong. When you smell the slightest discomfort from a EMI perspective, repayment of EMI perspective, you should be present at the customer's doorstep. So it is not an easy game for banks and other NBFCs to come in. Having said that, we are not the gatekeepers for this segment. Anyone can come. They can play well. But as I said in the beginning, the prayer is people should play it very safely, and so that this segment has not been destroyed.
So excluding money lenders, who are your major rivals in the formal segment?
Yes, our target segment is money lender. We go and disturb the money lenders market. That's point number one. We don't fight for a file with other NBFCs or other small finance bank. That's not our moat. Our moat is very clear. Go to the tier 3 and tier 6 towns of our country and disturb the money lenders market and bring that customers to the formal lending space, which is like borrowing from Five Star and other NBFCs. Two big difference or two big benefits our customers gets from moving from unorganized to organized lending space. One is their pricing is down. We lend 50% of the price what eventually they'll pay to money lender. So 50% of the interest cost is being cut when they come to Five Star. That's first catchy point. Second one is there is no concept of EMI in money lenders market. You have to pay the interest part alone. Principal you have to pay in a bulk. That is why if you see these customers be a permanent, they'll be caught in the debt trap permanently by money lenders, because these people, they cannot generate a 3 lakh to 4 lakh rupees at a go and to repay the principal what they have got from the money lender. Whereas in 5-star, it's a concept of EMI, where every month your principal gets amortized. Say, suppose a loan has been given for 5 years. At the end of 60th month, there is no outstanding principal, there is no outstanding interest. So these two are the catchy things. When we go and explain our product to the customers, immediately they come to 5-star because pricing is half and your principal gets amortized and you'll be debt free, maybe in 7 years or 5 years, depending upon the tenure you take. So this is our mode. This is how we go behind. And it, as I said, this is not an easy market to go and capture the customer and underwrite them and take them through in the collections effort that what we put at the ground level for a longer period of time. Suppose 60 months or 84 months, your collection team should be in to handle these kind of customers, especially during difficult times. So this is how we go to the market and capture our market share day by day.
So, but apart from, so no major competitors apart from money lenders.
So as of now, single product entity was created, assets of close to 6,000 crores will be only 5-star in our country. Following the footpaths of 5-star, many people have come in. Let me not name them, but their size is almost 50% or 40% of 5-star. And if you take their quality and profitability, 5-star will be in a different shape. The other competitors will be in a different shape.
From financial year 15 to financial year 20, the company witnessed a super growth. But in the past 2 years, the growth has been at around 15%. So what changed in that? What strategy changed in that 2 years? And how do you see the sector growing in next 5 to 6 years?
So as I said in my intro, from 2004 to 2014, 10 years, we were growing at 10-15% because we were learning this underwriting well. That is the key, right? In 2014, I decided we have built a super business model to cater to 22 trillion market opportunity in our country. So you need growth capital and growth team to make these things happen in a faster phase. So that is how the book grew from 130 crores in 2015 and close to 4,000 crores in 2020, being a fastest growing NBFC in that period of time. But having said that, once COVID hit us, NBFC was moved from 150 crores to 4,000 crores in 5 years. And that assets was being tested by the magnitude of COVID, what we suffered, both in COVID 1 and COVID 2, that definitely the assets would have been scrambled. I'm happy to say 5-star assets stood the time. We were one of the very few NBFCs who came out of COVID unscratched. I can share a data. Our worst asset quality was 1.68%, 90 plus. That was our worst asset quality, which we have seen in last few years. We are a very conservative company. When we saw COVID was hitting us very badly, we don't, even though the demand was there in the market, we want to be a very cautious lender. So we tightened our underwriting. We put our growth plan in the back seat, and we took the collections and quality of assets in the front seat. So that is why you see during COVID 1 and COVID 2, 5-star's quality of assets, both from collection efficiency as well as from 90 plus, you would have seen a big difference comparing with other NBFCs in our country. So consciously, we took the low growth phase. Demand was there. We didn't want in this difficult and unprecedented times. So we grew around 15% in COVID 1 and COVID 2. Now the COVIDs have all settled, as I said. From December, March onwards, our growth is back in form. Just to give you a number, between March quarter and June quarter of this year, we have grown 5 to 6%. And our profitability has moved from March quarter 119 crores to close to 138 crores in June quarter, with an 18% growth in one quarter. And our quality of asset stood around 1% both in March and June. So as we move forward, we'll be in a good growth trajectory, maybe much higher than the industry growth.
Okay. So one question which I had in mind was about the scalability. So like you mentioned that you follow the 3 C's model. So one of the things in that is ascertaining the character of the borrower. Now these things and you see that whether he's a drunkard or a gambler, or seeing what the character of the family is. So ascertaining all these things takes someone who's a local guy who knows everyone in the town and has some contact. So now when you speak of scalability, like growing your books maybe 4x, 5x, 10x over the next few years, do you think that would be possible? Following, like, would the same model be applicable even when you grow your book size?
Yes, of course. When the same question was taken to me when I was 100 crores, I replied the same answer. When the same questions hit me in 500 crores, I replied the same answer. Same question is hitting me when I'm in 5,000 crores. The reply is same. As long as you don't dilute your underwriting, your growth will be a sustainable and a profitable growth. How does you do that? One is you keep this, you train your people. See, I think there are 2 departments which is very core for underwriting. One is the business team, another one is credit team. Say today I wanted to open a branch at some region, right? Just not to name any region. I wanted to open a branch at one region. You have 2,500 officers in your pool. 5-star today has 2,500 sourcing officers in the pool. You will be having close to 1,500 highly performing guys in that pool, right? You have to just pick one guy. Performance is good means what? The productivity should have been good, and your quality and collection should be good, right? You just pick one guy and give him the branch manager position, right? He'll be thrilled and you will be also thrilled because his underwriting would have been good. That is why he is able to maintain that productivity with the asset quality and collections what he has been done. So when you give a career growth for that officer, you will be giving a 2 months training for him. He will be trained with the local, nearby branch by the branch manager, at least visiting 50 files, where he will be fine-tuned on both assessing the character, assessing the cash flow, and assessing the collateral which the family is willing to give. So after 2 months, he'll be given the position of branch manager and he'll be start inspecting and underwriting the files. This is first level of knowledge where we keep at the branch level. Second level of knowledge will be in supervisors. Today, 5-star has close to 80 supervisors above branch managers. These supervisors don't have any branch responsibilities. Each supervisor will be handling close to 5 to 6 branches. Their only responsibility is training the branch manager, keeping the productivity and business good, and ensuring the collections and quality of asset has been maintained for the 5 to 6 branches which they handle. So if they feel that branch managers underwriting is not good, they will also train him on both character, cash flow, and collateral, because those supervisors would have been in 5-star for last 5 to 7 years. They would have graduated as branch manager, senior branch manager, area manager, and to state head. So these are the 2 knowledge centers where we keep and promote ourselves from a business perspective. Tomorrow, 5-star wants to open 50 branches in this financial year. I have to pick 50 super performing guys out of 2,500 pools. It is so easy for me. It is not difficult. That is from the business side. From a credit side also, similarly, you have 2 types of credits. One is at the field credit. Every branch will have one field credit, and you have close to 300 field credits at 5-star. And you have close to 150 approval credits in 5-star. So tomorrow I want to move this approval credit. These approval credits today handle close to 12,000 files. Suppose for 20,000 files, I have to increase my approval credit from 150 to 200. I need 50 approval credits, right? I will pick 300 good performing field credits. I'll pick 50 out of this 300. I will only give the chance to the performing field credits. We have data on which field credit performance is good. That means comes in both TAT, productivity, and the quality of the asset, what that credit has assessed. We have the data. So it is easy to pick that 50 guys, what I need for next 2-3 years from 300 field credit pools. So both from the business side and the credit side, we have good amount of performing guys in our pool. So we will be picking that performing guys, give them the career progress, both in business and credit. So our underwriting never gets diluted.
Okay. So now you are primarily focusing on the 4 southern states. So are there any plans to expand geographically in the western parts or any other parts of the country?
Definitely, we can't be in the 4 states forever, right? But having said that, today, as of June, 95% of our assets are south-based. 95% of our AUM is in south-based. Only 5% of our assets come from non-south based, which is central India and western India. But even for going forward next short term, maybe we can call 3 years also, we'll be a predominant south player. 80 to 85% of our assets will be in south, whereas 10 to 15% of our assets will be in central India and western India. Having said that, we have put the seed branches and learning branches in northern states. We have few branches in Maharashtra and we very few branches in Chhattisgarh, and we have 1 or 2 branches in Uttar Pradesh. Those we call learning branches. So we will wait out for some time to get the green signals from the ground and how good the team has formed, what kind of underwriting that we are able to do, and how is the collection efficiency, how is the legal and collateral which is backing us is been underwritten there. So with these kind of inputs we keep getting, once our inputs are clear, then we ramp up the branches in those states from 4 to 40 in a very quick way.
Following up on the last question, in one of your interviews, you mentioned that the South market, from a lender's perspective, is more matured than the North. Do we have any interesting data or statistics which differentiates the North and South in the borrower's behavior or GNPA trends?
But definitely everyone has data. If you see the top performing NBFCs, leave the Bajaj, rest all is South, right? And you take any product, let it be gold or let it be microfinance, it all comes from South. So I think the data is very clear. A number of NBFCs in our country, I think South will have a lion's shares on it. I think the South market is, let me repeat, it's more matured because we have been seeing the South market lending for last 60 years. Sundaram Finance is there for last 50 years and more, 50 years plus. So it's a mature market. Your cash flows are predictable. And these southern states, they contribute good to the GDP and their income levels are going up year on year. And we have seen the best asset quality in South India. Let me not talk about other parts of the country, but South, I can very clearly say, both from collections perspective and growth perspective, it will be very safer, especially for a South guy like us.
Okay, so that's all the questions that we have for you. So I think it's fabulous talking to you, and we wish 5-Star and your team great success at the IPOs on the listing day. So thanks a lot for joining us on this call, and we wish you all the best.
Thank you from my side. Patiently listening this niche underwriting or niche segment in which 5-Star has created and mastered in it. And thank you for all the wishes which you all gave. So we'll be in connect going forward. Thank you.
For sure. Thanks a lot. Thank you.